Hey, what's up, everybody? So, welcome to Buckets of Volatility, Liquidity, and the Fed Reserve, Episode 2, where I'm discussing liquidity from what you can see on the charts, and then we will go through and gradually get into more and more complex topics, right? So, in this topic, I want to talk to you about what term structure is, backwardation, and contango, right? And these are, the central effect, and like the mean reversion plays, right? And as I slowly am introducing to you how the Fed Reserve commercial banks are the puppet master of liquidity, you have to be able to see the effects from the causation to make money and be in the right area of the market during the right market conditions, right? And since we are talking about the VIX, it's only fair to learn how the Fed balance sheet is the ultimate VIX suppressor or enhancer and market liquidity indicator, right? So if the Fed adds assets to their balance sheet, volatility will go down, causing more liquidity in the market, right? If they're tightening their balance sheet, then they are pulling liquidity out of the market, causing more volatility due to less liquidity, buyers and sellers, less buyers and sellers, right? So look at the chart below at the Fed balance sheet, and I overlaid VIX over time, right? Every time they did quantitative easing, which is engineered liquidity, it tamed their market volatility, right? And every time they tightened the balance sheet, it took liquidity out of the market, causing more volatility, right? So now, attention to the dates in the boxes that I have highlighted here, where the Fed Reserve's adding liquidity to the markets through adding to their balance sheet, quantitative easing. And I want you to see the correlation between this, right? And then I also want you to see that since COVID, the VIX has never fallen back to its normal level, right? Now, we know big institutions and funds need liquidity to enter and exit, or they will suffer, right? And this is why Ray Dalio was one of the most successful. He knew how to reduce volatility while maintaining returns, right? And that's what we all should be, our goal should, and that's what gives you a great Sharpe ratio, which is the result of reducing volatility, finding risk opportunities, and keeping high returns within your portfolio, right? And as retail traders, there's no reason we can't do that, right? But back to the VIX, right? Because the VIX hasn't returned back from pre-COVID, level of liquidity. Pre-COVID levels, liquidity hasn't truly recovered, right? And because we have seen higher volatility in the VIX, it shows us this because liquidity, which is the opposite of volatility, as we discussed in the last episode, right? Higher volatility means people don't want to assume more risk, which is why the Fed Reserve was cloning reserves and doing quantitative easing, between commercial banks and non-commercial banks, aka shadow banking, right? And you got to realize that a fund has to adjust their positions for volatility, right? Like a market maker has to adjust its positions for delta and gamma exposure when it moves, right? Why? Because every point the VIX goes higher, the more risk the fund's current positions have. Without making any changes to the portfolio whatsoever, every time the VIX goes up, that's more risk that they're assuming, right? This is why the post-COVID rally was as extreme as it was, right? It moved up in a straight line without having more than a 5% pullback in the last 2 years, right? So, how can we measure this? And how can we make money off of this information, right? So you have to be able to understand what kind of market conditions that you're trading in. So I'm about to start going over some of the things that I use, right? And so feel free to pause the video, write down the tickers, do what you gotta do to screenshot the videos so you can use them as notes in your own journals, right? So you can learn it. So the VIX futures contracts, has a current month, next month, and the month after, and the month after, and the month after, which creates the term structure of the VIX, right? And the forward curve, right? Which we're going to get into, right? All right, so if you take next month's contract minus this month's contract, so VX2 exclamation mark minus VX1 exclamation mark, you're going to get the spread in between, right? And so the VIX futures contract backwardation has the current month contract being more expensive than the next month's contract, right? And contango is when price rises with time, as you would expect in a normal market, right? Looking at price today for the future should be more expensive, right? Think of options, right? Which one should be cheaper? The expiration date that expires this month or the one that expires 3 months from now, right? You're paying for time. You're buying time to hedge your positions. And if, just in case you're wrong within the movement, right? Well, now, you got to realize within the VIX, if it's below zero, then people are paying for protection now, and they're spending more money on this month's contract than they are next month's contract. Let that sink in. So when the now contract cost is more than the future, it shows us the emotions of the markets in regards to urgency, right? VIX backwardation is the now contract being more expensive than the next month contract. All right, people are bidding up volatility now versus next month. It shows fear in their market. People are buying protection now, not a month from now, because the fear is now. When you see VIX ripping, it is managers buying protections at the silliest times and the most expensive times, right? Because they didn't forecast today's market conditions, right? Why is it silly? Because it's too late to be protected without paying the piper, right? And that is why you see this month's contract more expensive than next month's contract. The term structure is the price of the contract from today going forward, right? So VIX current month contract, the next month contract, and so forth, right? If the term structure goes negative for this month VIX contract minus next month, right, it shows us pure emotions of the size traders in the market, right? And as you can see, the last month backwardation was the calmest because the market doesn't believe in the current market conditions and the Fed's plan to fix inflation, right? So now before we go into that, I want you to look at this contract at 2020, 2019, 2018 when the market started, dropping because of the Fed pivot. Go to 2008, 2009, the financial housing crash, right? Go to the dot-com bubble. You're going to see the same patterns, right? So the seriousness that the market is taking with the inflation expectations being fixed by the Fed, they're not taking it too serious because this is the first indication of a blowout in fear, So contango is normal, right? So it's normal conditions, right? This month contract is cheaper than next month's. And now when looking at the VIX at face value, like just having the VIX pulled up, it isn't as helpful as to look at the spread between contracts, Compare 2018 VIX to now VIX, In 2018, we went from 11 to 30, where now we are 30. The 30s are the norm, right? We went from 20 to 30, and everybody started freaking out, right? So remember, when the VIX 1 is more expensive than the VIX now, we're in backwardation. When next month's contract is more expensive than this month's contract, we're in contango, which is normal. Right, so the key is to watch when you ever get an equity sell-off, right? You need to see the tempo of how the term structure of the VIX is acting, right? Now let's look at this theory with crude oil. So take CL2 minus CL1, that's the spread, right? And you're going to see that crude oil was in contango until January 2021, and then it started slowly going into backwardation. And so the demand for this month contract is exceeding more expensive than the barrel of oil for next month, right? So look at this theory with crude oil, right? The crude oil term structure spread was in contango, and then it started going into backwardation, increased demand, right? So people are willing to spend more money for oil now than next month, right? that tells us a lot about inflation, if it's supply-driven inflation or demand-driven inflation. So let me back that up. Like, that's a sign, right? There's a lot more indicators that you have to use to figure that part out, right? So you can see backwardation as well, clear as day. Every month forward is less expensive than the previous month, right? Like, look at the forward curve on crude oil, right? You know, like, this month should not be expensive and next year should be that cheap, right? So when you're doing this, you have to take into consideration this month's contract getting closer and closer to OPEX, because you're going to see a lot more false signals on it. So just skip to the next month, like month 3 minus month 2, like the week of OPEX. So we'll go check this out. Like, that will end it for this time period, and like the next time period we'll go into the other things that I use to gauge, you know, the liquidity in the market. With this, right, commodities are usually an inflation hedge, right? And they are until, you know, the Fed starts to come off hawkish, right? And that will kill the front month prices, because commodities get crushed during rate hikes, right? And as we transition to deflation, right? However, you also have to think, because the inflation we're dealing with right now is supply driven, you know, supply chain disruption, we have a food shortage about to happen, commodities might continue to find a bid, keeping us in stagflation, right? So if you buy commodities during, you know, stagflation, you know, you're fighting against the Fed. You know, you don't know if we're early peak cycle, we don't know if we're peak cycle, we don't know if we're late cycle. We just know that as long as commodities go up along with other asset classes, the market's telling the Fed, we don't believe you. Don't play that game. It's a deadly one for your account. Alright guys, later.